Welcome to this explainer. Today we're diving straight into the hidden, intricate links between the Federal Reserve's secret strategies, Middle Eastern geopolitics, and that everyday inflation you're feeling right now in your wallet. If you want to know what is actually driving the markets, beneath all the headlines and political noise, you are in exactly the right place.
Okay, let's take a quick look at our roadmap. We've got 6 parts today: the Fed's master plan, the banking Rube Goldberg machine, the geopolitical wrench, the ticking oil time bomb, decoding the Fed signals, and the new commodity supercycle. Basically, we're going to connect the dots all the way from Wall Street down to the Strait of Hormuz to show you how this whole thing operates.
All right, kicking things off with part 1, the Fed's master plan, growing the economy without triggering a debt crisis.
So, to solve this massive US debt problem without blowing up inflation, the Fed needed a seriously brilliant strategy. And you know what's wild? The market thinks it already knows the play. The CME FedWatch tool shows a 97.4% chance of 0 rate changes at Kevin Warsh's meeting this Wednesday. Literally 0. And because that's already priced in, Warsh's words, his tone, his little hints are going to matter way more than his actual actions.
What he's signaling really boils down to a 3-step playbook. Step 1, lower short-term interest rates to loosen up the economy and fuel growth. Step 2, simultaneously shrink the Fed's balance sheet by selling off bonds, which pushes long-term rates higher, creating what's called a steeper yield curve. And Step 3, deregulate the banks.
Which brings us to part 2, the banking Rube Goldberg machine, turning commercial banks into a covert money printer.
Okay, this is where it gets fascinating. That deregulation step activates a complex machine using something called the Supplemental Leverage Ratio, or SLR. Think of the SLR as a VIP club for safe assets like Treasury bonds that hit its absolute maximum capacity after 2008. By permanently loosening this rule, Warsh is basically letting banks bypass the bouncer. They can suddenly pile into treasuries using massive leverage. And here is the Rube Goldberg magic of it all. The Fed gets to look like the highly responsible adult in the room by shrinking its balance sheet. But behind the scenes, commercial banks absorb all that debt, which is effectively printing money. And if anyone points a finger at inflation, well, the Fed just points to AI. Warsh has actually noted that the AI boom acts as a huge disinflationary force, making workers so productive that it drives costs down, perfectly masking this backdoor money printing.
But then, enter part 3, the geopolitical wrench, how the Iran conflict hijacked the economic machine. Right when this master plan was perfectly priced into the markets, boom, a massive geopolitical wrench gets thrown into the gears. After the military actions on April 1st, the Strait of Hormuz is essentially shut down. Now, this isn't just any waterway. It controls roughly 20% of the global oil supply. So, the strait closes, oil spikes. Oil spikes, inflation spikes. And when inflation spikes, the Fed has no choice but to push short-term interest rates right back up. Just like that, Warsh's carefully laid trap is completely shattered. You can actually see the damage right here. Look at that steep green curve. That's exactly what the Fed wants. Banks borrow cheap on the short end, lend high on the long end, and happily buy treasuries with those profits. But the Iran conflict gave us that flat red curve. Short-term rates spiked, the spread virtually vanished to a microscopic 0.4%, and the banks just walk away. They are not going to lock up their money for 30 years to make almost nothing. The whole machine just grinds to a halt.
Moving right along to part 4, the ticking oil time bomb, the silent clocks threatening the US bond market.
This geopolitical disruption didn't just break the machine, it started 2 incredibly dangerous silent clocks. The first one is ticking down from 80. We literally have less than 80 days until the Strategic Petroleum Reserve allegedly runs dry. That reserve has been the ultimate shock absorber, keeping gas prices somewhat sane during this Hormuz closure. Once that buffer is gone, we feel the full blow.
And while that oil clock is ticking, we've got a second one with a terrifyingly large number attached: 8 trillion. The US Treasury urgently has to refinance $8 trillion of debt in just the next 12 months. And they have to do this in a market where interest rates are climbing and reliable foreign buyers are just vanishing, opting to buy gold instead of US debt.
It's honestly like a giant game of impartial global chess. The source material outlines that Iran doesn't even need a military victory here. They are just patiently waiting for high interest rates to fracture the over-leveraged US bond market. At the same time, China is strategically timing tech announcements, like dropping cheap, powerful AI models right when major US tech IPOs launch, directly challenging U.S. market valuations. This structural pressure is exactly why many argue that securing a new Iran deal isn't just politics, it is a dire economic necessity to save the bond market.
So, Part 5, Decoding the Fed's Signals, your cheat sheet for Wednesday's press conference.
With the master plan paused and the clock ticking so loud, Warsh has to walk a total tightrope this Wednesday. Seriously, keep this cheat sheet handy. If he calls the current inflation transitory, that's dovish, meaning he thinks the oil spike will fade and markets will probably rally. If he says persistent, that's hawkish. Expect markets to drop. But here's the golden signal. Listen for any mention of stress in the bond market. That tells us they're ready to inject liquidity, meaning hard assets like gold and Bitcoin could surge. Finally, watch the DXY dollar index right after he talks. If it drops, the market is pricing in future liquidity. If it rises, buckle up for higher rates and more pain ahead.
Which leads us perfectly to our final section, Part 6, the new commodity supercycle. The historic pendulum swings back to real assets. You know, regardless of what words Warsh uses this week, the big picture points to a massive, once-in-a-generation shift. Let's talk about the commodity supercycle. We're looking at a 15 to 20-year period where wealth fundamentally rotates. That whole era of paper assets, like standard stocks and bonds, massively outperforming, it's fading. The pendulum is swinging hard toward real, tangible assets: gold, oil, silver, and arguably digital hard assets like Bitcoin. These are the things that actually thrive when the system is structurally inflationary.
And history tells us this is inevitable. Look at the timeline here. From 63 to 80, we had a super cycle driven by oil shocks and the end of the gold standard. From 97 to 2011, it was driven by China's massive globalization wave. Now, this current cycle we are in, which kicked off around 2020, it's fueled by the exact opposite forces: deglobalization, unprecedented record debt, and crazy money supply expansion. The wildest part is, we're only about 6 years into a cycle that usually lasts up to 2 full decades. So as the Fed tries to pull off this high-stakes economic heist while dodging global hijacks and a ticking bond market time bomb, the real question isn't just what happens on Wednesday, it's this. With the pendulum swinging so decisively toward real, tangible assets, is your portfolio actually prepared for the dawn of the supercycle? Think about that as you watch the markets open this week. Thanks so much for joining me on this explainer. Keep learning, keep watching the data, and I'll catch you next time.